Imagine waking up one morning and realizing the clock has finally run out. Not because of a rumor, not because of a tweet, but because the math itself has stopped cooperating. That's where the story really begins. Not with a date on a calendar, but with a number so large it almost sounds fictional: 8.7 billion ounces of silver. That's the position JP Morgan Chase has been sitting on quietly for years. And according to a leaked CFTC enforcement document, the quiet part is officially over. For more than a decade, traders and analysts whispered about silver being held down by an outsized short position. It was always framed as suspicion, never proof. Until now, the document doesn't speculate. It calculates. It lays out internal risk models from JP Morgan itself. And buried inside those projections is a number that should make even seasoned market veterans sit up straight. A worst-case exit price of $847 per ounce. Silver closed last week around $80. Gold is already north of $4,200. You don't need a PhD to see the implication here. If silver were to realign even partially with historical ratios and supply realities, we're not talking about a gentle move upward. We're talking about a near tenfold reprice. That's not hype. That's JP Morgan's own nightmare scenario, written in their own spreadsheets. Now here's where it stops being abstract and starts getting uncomfortable. According to the same document, JP Morgan has roughly 45 days to close this position. 45 days to buy back 8.7 billion ounces of silver in a world where annual global mine production is about 840 million ounces. Let that sink in. They need to source more than 10 years worth of global production in a month and a half. If your brain just rejected that number on instinct, that's a healthy reaction. Because mathematically, it doesn't work. And that's before you factor in the other buyers who are already in the market. China, for example, isn't browsing the silver aisle casually. They're strategic. Reserves program is accelerating, with targets approaching 30,000 metric tons, roughly 965 million ounces by year-end. That's nearly an entire year of global production spoken for by one buyer. So you have a forced buyer with the largest short position in history, racing the clock, colliding head-on with a sovereign buyer who doesn't care about price discovery. They care about metal. Real metal. Physical supply that already isn't there. You can see the stress fractures if you step outside the spreadsheets. Walk into a coin shop today and ask for 100-ounce bars. Watch the dealer's expression change. Premiums are climbing. Inventory is thin. And this is before any official liquidation begins. The shortage isn't theoretical. It's already showing up at the retail level. What makes this moment different from every other silver squeeze story you've heard is that this isn't coming from internet forums or speculative blogs. It's coming from leaked federal enforcement material. It outlines a mechanism, a timeline, and a failure mode. And perhaps most importantly, it fits a pattern that has played out before perfectly. History doesn't repeat because people are lazy. It repeats because incentives in mathematics don't change. Every manipulated market collapse follows the same arc. Different assets, same story. First comes control, then overreach, then a trigger, then liquidation. The names change, but the ending doesn't. At the beginning, a dominant player gains concentrated influence during a moment of stress or regulatory blind spots. Prices behave. Volatility stays low. Everything looks stable. Behind the scenes, the position grows so large that the institution isn't participating in the market anymore. It is the market. It's like building a dam one concrete slab at a time. From the outside, it looks strong. Inside, pressure keeps building. Then comes expansion. The position grows beyond what the physical market can actually support. Price suppression becomes self-reinforcing. Every dollar held down increases the eventual exit cost. But exiting isn't an option because the act of exiting causes prices to jump. So the position gets bigger. More leverage, more exposure, more confidence. This is where human psychology quietly sabotages risk management. When things work for long enough, caution starts to feel unnecessary. Stage 3 is where reality intrudes. A regulator steps in. A competitor shows up with deep pockets. A geopolitical event breaks correlations. Physical shortages surface. Whatever the trigger, the institution loses control. At this point, there is no clean exit. The math is already baked in. Losses are unavoidable. The only question is who absorbs them. And finally, liquidation. Forced selling or buying into a market that simply cannot absorb it. Prices gap violently. Counterparties fail. Assumptions that held entire industries together unravel. And the damage doesn't stay contained. Everyone downstream feels it. We've seen this movie before. In 1980, the Hunt brothers controlled about 200 million ounces of silver, roughly half the available supply. They thought inflation would destroy the dollar, and silver was their hedge. At first they were right. Prices rose. Confidence grew. Then the rules changed. The exchange cut off new long positions. Margin calls followed. Silver crashed from nearly $50 to under $10. The Hunts were wiped out and later charged with manipulation. 200 million ounces nearly broke the system. J.P. Morgan's position is more than 40 times larger. In the late 1990s, long-term capital management had Nobel Prize winners' flawless backtests and returns that seemed to confirm mathematical certainty. They used leverage to magnify tiny price discrepancies. It worked until it didn't. When Russia defaulted in 1998, correlations snapped. Positions moved together instead of offsetting each other. LTCM was so large that trying to unwind made the losses worse. The Federal Reserve had to organize a bailout to prevent systemic collapse. They weren't wrong about the math. They were wrong about the world. And more recently, in 2021, Archegos Capital showed how dangerous invisible leverage can be. Using swaps, Bill Hwang controlled massive stock positions without disclosure. Banks didn't see the full picture. When prices turned, margin calls cascaded. Credit Suisse alone lost $4.7 billion. Archegos vanished almost overnight. Each case followed the same pattern. Concentration, overconfidence, trigger, forced unwind. Now look back at silver. Look at the size of the position. Look at the physical constraints. Look at the timeline. And then look at that internal J.P. Morgan projection. $847 per ounce in a severe exit scenario. March 15th isn't just a date. It's a deadline imposed by arithmetic. It's the point where a 15-year suppression strategy collides with finite supply, regulatory pressure, and global competition for real assets. Markets can ignore reality for a long time. They can't ignore it forever. At some point, the dam doesn't leak anymore. It breaks. The moment CBS announced a $3 billion stock offering, the illusion snapped. Dilution isn't just a headline, it's gravity. The stock dropped 9% in a single day. And that one move was enough to expose everything hiding underneath Bill Hwang's empire. His positions weren't just large, they were stretched thin with leverage. That 9% decline triggered margin calls across the board. Suddenly, the banks weren't interested in theories or long-term stories. They wanted collateral. More of it. Immediately, Hwang didn't have it. That's the dirty secret of leverage. It looks powerful right up until the bill arrives. With no cash to post, he had only one option: sell. But selling into a falling market is like trying to jump out of a plane while grabbing the wing. Every sale pushed prices lower. Lower prices triggered more margin calls. More margin calls forced more selling. And just like that, the death spiral was in motion. Once that first forced sale happens, the outcome is locked in. There's no pause button, no negotiation, no clever restructuring. The system does exactly what it was designed to do, and it does it without mercy. By March 26, 2021, the banks gave up on coordination and went for self-preservation. They dumped Archegos positions all at once. Viacom CBS collapsed 57%. Discovery fell 45%. Baidu dropped 33%. Credit Suisse alone lost $4.7 billion. Nomura lost $2.9 billion. Morgan Stanley took a $900 million hit. Total losses crossed $10 billion. Archegos was erased. Bill Hwang was later indicted for fraud and market manipulation. 3 different markets, 3 different decades, same script, same ending. And that brings us to now. Because what happened to Archegos wasn't an anomaly. It was a rehearsal. The pattern is consistent, and J.P. Morgan is standing in the exact same place in the sequence, just with numbers so large they stop feeling real. This isn't about hedge funds anymore. This is about the plumbing of the global financial system. The setup began in 2008, right in the middle of chaos. J.P. Morgan acquired Bear Stearns during the financial crisis, and along with it came Bear's massive commodity trading operations, including substantial silver short positions. At the time, nobody blinked. Regulators were focused on keeping the system alive, not on scrutinizing commodity books. J.P. Morgan didn't just inherit those positions, they consolidated them. Then they made a choice. They could close the position early, take losses, and move on. Or they could expand it, suppress volatility, and effectively control the market. They chose control. Silver was the perfect target. It's both an industrial metal and a monetary metal. The market is relatively small. Supply chains are concentrated. And paper derivatives can create the illusion of abundance far beyond physical reality. By 2010, whistleblowers were already raising alarms. A trader named Andrew Maguire submitted detailed evidence to the CFTC, documenting spoofing, coordinated selling, and extreme concentration. The CFTC investigated for 5 years. In 2015, the investigation quietly ended with no charges. The position, however, didn't end. It grew. What people misunderstand is that J.P. Morgan didn't stumble into manipulation by accident. They inherited a problem, assessed the risks, and decided that dominating the market was safer than admitting defeat. They built the dam higher, knowing full well that pressure was building behind it. The leaked CFTC document confirms just how far that expansion went. Between 2008 and 2023, JP Morgan accumulated a net short position of roughly 8.7 billion ounces of silver using futures, swaps, and over-the-counter derivatives. Global silver mine production is about 840 million ounces per year. JP Morgan's short position represents more than 10 years of total global output. Put another way, the COMEX currently has around 38 million ounces of registered silver available for delivery. JP Morgan is short roughly 229 times that amount. The Hunt brothers controlled about half of global supply in 1980. JP Morgan's exposure dwarfs that by orders of magnitude. How did they keep this going? Synthetic supply. Every time physical demand pushed prices higher, more paper silver was sold. Price stayed suppressed, demand cooled, and control was maintained. In 2011, when silver hit $48, they expanded shorts. In 2016, when silver ran to $20, they expanded again. In 2020, when silver surged to $28, they added more. Each defense required a bigger position. Each bigger position made the exit more dangerous. And here's the part that matters most. Internally, they knew. Emails from 2019 show traders questioning the scale, risk managers flagging liquidity concerns, analysts modeling exit scenarios that looked ugly even on optimistic assumptions. They weren't ignorant. They just assumed time was on their side. They assumed regulators wouldn't force a reckoning. They assumed they could finesse the math. That assumption broke in late 2025. A separate CFTC investigation into precious metals manipulation reached critical mass. Traders flipped. Digital communications showed coordination. Emails demonstrated intent. What had been whispers turned into evidence. JP Morgan was presented with a choice: face criminal prosecution that could cascade through derivative markets and threaten systemic collapse, or accept a settlement. They chose settlement. The terms are staggering. JP Morgan must fully exit its silver short position by March 15, 2026. Roughly 45 days. They must do so in an orderly manner designed to minimize disruption. And embedded in the agreement is JP Morgan's own risk modeling. In their base case, silver rises to $187 per ounce, costing them $1.38 trillion. In the adverse scenario, silver hits $394, with losses exceeding $3 trillion. In the severe case, silver reaches $847 per ounce. Physical shortages become acute, and losses turn systemically threatening. These aren't outsider projections. These are JP Morgan's numbers. And this is where silver's dual nature turns a financial problem into a physical crisis. You can create infinite paper contracts. You cannot create physical silver. China understands this. In December 2025, China announced a strategic reserve target of 30,000 metric tons by the end of 2026, about 965 million ounces. More than an entire year of global production. And they're not buying paper. They're buying metal directly from mines and refiners. Now combine that with JP Morgan being forced to close 8.7 billion ounces of shorts. Even if only a tiny fraction of counterparties demand physical delivery, the system breaks. COMEX doesn't have the inventory. One default triggers another. Confidence evaporates. Physical premiums explode. Paper and physical prices separate permanently. We've seen a preview before. In early 2021, retail buying pushed physical premiums $8 to $10 over spot. That was maybe 100 million ounces of demand over weeks. Now imagine institutional buyers chasing billions of ounces in a month and a half. The supply simply does not exist. People will say JP Morgan is too big to fail. Maybe. A bailout could shift losses onto taxpayers, but it doesn't change the underlying math. Those ounces still need to be bought. The pressure doesn't disappear. A bailout saves the bank, not the market structure. Others will say technology, models, and sophistication will solve it. LTCM had Nobel Prize winners. Archegos had cutting-edge derivatives. Neither escaped arithmetic. No algorithm can mine silver faster. No model can conjure 10 years of production in 45 days. And here's the uncomfortable twist. This crisis may actually strengthen the dollar. A silver shock destabilizes commodity markets, foreign supply chains, and alternative stores of value. In chaos, capital runs to the reserve currency. From that perspective, a controlled demolition of silver may be seen as preferable to a later, broader derivative collapse. Today is January 12, 2026. According to the leaked document, JP Morgan began exiting on February 1st. That leaves about 42 trading days. Watch the first 2 weeks. Quiet covering, algorithmic trades, off-exchange deals, prices drifting higher, media calling it a rally, no mention of forced liquidation. By late February, the story changes. Physical premiums widen, supply tightens, prices accelerate. By early March, Shortages become undeniable. At that point, it's no longer about silver investors. It's about supply chains, inflation, and trust. This isn't the end of the story. It's the moment the math stops being theoretical. Whether JP Morgan survives is almost secondary. What matters is that a 15-year distortion is colliding with reality. And reality, as always, doesn't negotiate. What gets lost in all the noise about price charts and deadlines is the damage that's already been done. Years of artificial price suppression didn't just hold silver down on a screen. It quietly rewired the real economy around it. Mining companies underinvested because the price never justified expansion. Why sink billions into new projects when the market tells you silver is cheap and likely to stay that way? Industrial users built cost models assuming stable, low prices. Governments treated silver as abundant, not strategic. Reserves were left thin. And now, when reality finally pushes back, everyone discovers the same thing at the same time. The cupboard is bare. That's why this doesn't end the day. JP Morgan exits its position. Even if they manage to close every short by the deadline, the physical shortage doesn't magically disappear. Mines don't spin up overnight. New projects take years, sometimes a decade. Supply chains don't heal in a quarter. What we're looking at is a multi-year restructuring of the global silver market, not a one-month spike and fade. The price may move violently in weeks, but the consequences will linger for years. This is also why timing matters so much. Information is power, and it always has been. Most people won't hear about this until silver is already trading north of $200. That's when the mainstream media wakes up. That's when the talking heads start explaining it with hindsight. That's when your neighbor casually asks if it's too late to buy silver, which is usually the market's way of saying yes. You're hearing about it now, before it's comfortable, before it's consensus. That's the advantage. Use it. Zoom out for a second and ask the bigger question, why does this keep happening? The Hunt brothers, long-term capital management, Archegos, now JP Morgan. Different decades, different instruments, same failure mode. It's not coincidence. It's incentive. Modern finance is built on asymmetric risk. When trades work, the upside belongs to the institution, bonuses, prestige, market power. When trades blow up, the downside is shared. Bailouts, backstops, systemic importance. Heads I win. Tails you pay. That structure doesn't punish excess. It rewards it. So each generation pushes further than the last. The Hunt brothers took control of half the silver market and were crushed. The system survived. So the lesson wasn't don't do this, it was don't do it like that. LTCM used leverage and models so sophisticated they felt invincible until a black swan reminded them that humans panic and correlations break. The system survived again. Archegos hid leverage in swaps and family office opacity until gravity returned. The system survived. So the next player went bigger, much bigger. JP Morgan didn't dabble. They scaled the trade to a level no one had ever attempted before. 8.7 billion ounces, 10 years of global production. A position so large it stopped being a trade and became a structural feature of the market. And now we're watching what happens when a structure built on paper meets a world governed by physical limits. Here's the part that should really bother you. JP Morgan is one bank, and silver is one commodity. How many other positions like this exist right now? How many markets look calm on the surface because a handful of institutions are sitting on massive, concentrated exposures? How many deadlines are out there that we don't know about yet? The leaked CFTC document isn't just about silver. It's a flashlight pointed briefly into a very dark room. And what it reveals isn't comforting. Silver is relatively small as markets go. If distortions of this scale can persist here for 15 years, imagine what's hiding in bond markets, or currency swaps, or the derivatives complex that stretches into the hundreds of trillions, and is understood by almost no one outside a small circle of specialists. JP Morgan's silver position may be the crack in the dam, not the dam itself. The uncomfortable question is how much pressure is behind everything else. As of now, the clock is still ticking. March 15th, 2026 is roughly 2 months away. By that date, JP Morgan is required to close a short position larger than 10 years of global silver production. They're doing it while competing with China, which is actively absorbing physical supply. They're doing it in a market where the primary futures exchange had about 38 million ounces registered for delivery. They're doing it under regulatory scrutiny and a fixed deadline. The math isn't flexible. It doesn't negotiate. It just waits. By now, you've seen the pattern clearly. Concentration, expansion, loss of control, forced resolution. We've watched it play out with the Hunt brothers, with LTCM, with Archegos. And we can see exactly where JP Morgan is right now, deep into the crisis phase. Stage 4 is coming. That doesn't mean one exact outcome, but it does mean one of a few narrow paths. An orderly exit that drives silver into the low hundreds. An extended crisis that drags prices toward $400. Or a catastrophic break, where physical scarcity forces are repricing toward the severe scenario JP Morgan itself modeled around $847. Those aren't internet fantasies. They're the bank's own numbers. So what do you do with this? First, understand that this affects you whether you own silver or not. Silver is embedded in modern life, electronics, medical devices, solar panels, EVs, industrial machinery. When silver prices spike, costs ripple through supply chains. Inflation doesn't just come from central banks printing money, it comes from real shortages in real materials. Phones cost more, cars cost more, energy infrastructure costs more. This is a supply shock, not a spreadsheet adjustment. Second, understand that paper and physical are not the same thing. ETFs and derivatives are promises. They work until they don't. When physical shortages hit, premiums detach. Paper prices can say one thing while actual metal trades at another. We've seen this already in miniature. In a real crisis, that gap becomes a canyon. Third, recognize what this signals beyond silver. This is a stress test the system didn't volunteer for. If it breaks cleanly, other markets will take notes. If it breaks badly, confidence everywhere takes a hit. Either way, the era of assuming markets are deep, liquid, and infinitely flexible is ending. And finally, appreciate the timing. You're not late. You're early. That doesn't mean easy. Early is uncomfortable. Early sounds dramatic before it sounds obvious. But history is unkind to people who wait for confirmation. By the time everyone agrees silver's going higher, it already is. By the time CNBC runs specials explaining what went wrong, the opportunity is past. Right now, silver is trading around $80. Gold is pushing levels that would have sounded absurd a few years ago. In a matter of weeks, silver could be at $200 or $400 or somewhere that forces a complete rethink of what price even means in a constrained physical market. The scenarios are laid out. The models confirm them. The pattern demands resolution. You now have information most of the market doesn't. You understand a structure most people won't notice until it's already collapsed. What you do with that is up to you. You can watch passively and say wow later. Or you can prepare, position, and think a few steps ahead of the crowd. We're not watching just another market move. We're watching a long-running distortion finally collide with reality. The moment paper promises meet physical limits. The moment a too-big-to-fail institution faces a position too big to unwind quietly. March 15th is more than a date. It's a line in the sand where mathematics takes over. Mark it, remember it. Because one way or other, when that day passes, the silver market, and probably a lot more than just silver, will not look the same again.